Well, hello and welcome to our Jazz After Dark. We got to get that old British guy to make us intro for this thing, actually. Cody, let's see if we can get him to do one for Jazz After Dark. The guy has like the perfect raspy voice. He's the guy that we play before the closing beat show. Awesome, awesome guy. Real nice guy, too. Welcome. It is almost the end of the year, and if it's not when you're watching this, then here's a good time anyways to just think about how to review your finances. You're going to see all kinds of different things online about what to look at and, different YouTube videos. But I promise you, nobody, like we always do, nobody has done it like this before. I want to make it simple, right? This should be simple. You grab a drink tonight. I happen to be enjoying the Buffalo Trace. If you're a Buffalo Trace fan, it's kind of my go-to. Buffalo Trace is a solid 92 out of 100, right? If I could be like a point rater guy for bourbons and whiskeys and stuff, I would give it a 92, solid all day. But the point I was trying to make is, by the time you finish a quick drink, you should be able to review your finances in extreme detail, right? And there can be layers of this, by the way. You could say, I'm going to start with the things that I want to look at, and does it require further analysis, right? A long time ago, I just started writing things out, and then I moved to a spreadsheet, and then my wife got bored of all of it, and I said, okay, going to make this real simple. I just want you to answer yes or no. And if it's something more complicated, I'll handle the details. We have a thing in our family here. She handles the medication, and I handle the money. Yeah, know your fortes, All right, let's get started here because I don't want to take forever with you. Number one, we're going to start with your cash flow. Most important thing, cash is going to get tight. I want you to take a look at this, maybe screenshot it. You can take it with you. You might even notice that I'm referencing other videos that we've done for you publicly, some of them privately for clients, but I want you to take a look. First three questions. Any change to your budget this year? Any change to your employment? Or any change to the amount that you've been saving? It is more likely that this year there's been changes to your employment and how much you're saving. If you found a weakness throughout the year where you needed to pull back your savings for retirement, that's understandable. We have lots of clients that have done that. And that to me is a red flag. Okay, you're pulling back your retirement savings. It's probably fine. There's no need to worry about it. But what's going on? What's going on with your finances? What can I help with? If you work with us here at Jazz, of course, I'm happy to help. But you may want to analyze, why did things change? Next one, do you max out your workplace plans, retirement plans that you're trying to shoot for? And should you be doing a backdoor Roth? What did we talk about last night? How do we do a backdoor Roth? And what's the actual way to do it? Not the way that everybody tells you on TikTok, right? The actual way to avoid the tax. If you make a lot of money, maybe you're doing a mega backdoor contribution. Right? So things to consider there. Do you have extra side income? And I put solo 401k, but people sell things on Etsy. Maybe you drove for Uber, the normal stuff that people do, or maybe you're a little bit unique and you have some weird drop shipping thing that I don't know about. If that's other extra income, you may be looking at the SEP IRA as a good example, real simple account to set up, not a big deal there, but things like that is what you want to consider if your cash flow changed, your employment changed, meaning maybe now you have a second side job, or like one guy, this is not a joke, by the way. I have one client. If he wants to leave a comment, he can. Works full-time remotely for 3 different companies. And it doesn't seem that you would know all 3 of these companies, by the way, very name brand companies. But he works full-time, and that this year has changed. His income went from 1 full-time job to 3 full-time jobs, where he has the opportunity of 3 401ks, he has the opportunity of 3 healthcare plans, he has the opportunity of putting a lot of money away. So that's what I mean by change there. Down the line here, If you're taking distributions from your accounts and you're retired, do you need to talk about the rate of withdrawal? Did you take a little more this year, but the stock market fell and that worried you? Did you take a little less because the stock market fell and now you're cutting it a little close? That's a great talking point right there, or a great data point for you to figure out what needs to adjust there. If you need to take an RMD, whether because you are of RMD age, or is it here? Yeah, inherited account. Are you ready to take your RMD before the end of the year? This is the one thing I'll throw in and then we'll move on. If you inherited an IRA in the last 3, 4, 5 years or not further, in the last 3 years or so, the IRS has clarified now that you must take an RMD every year, even though that new 10-year rule went into play. They mean 10 years, but oh, by the way, every year you take something, so by the 10th year you have depleted the account. And then you're gonna move. The dog's just moving around. So make sure you follow that. Now they're going to waive the first 2 years, realizing they made a mistake and they weren't very clear on that. But you now need to take that withdrawal. There is no forgiveness there because now the rule is crystal clear. Do you want to review your employee benefits, making sure you are, well, basically contributing up to the match? Do you get a health savings account contribution? Are you looking to spend the rest of your FSA, or do you get that one-time carry forward like a lot of them do? Have you spent your money on your dependent care and all those different accounts? Just a quick glance is really all you need to look at. Are you looking for that college plan going into the next year? Is this the year to start a 529? I would also argue that maybe you compare the 529 to the custodial account. More and more people are starting to go that way and want that extra flexibility. It's just a comparison. It's something that you want to look into when the holidays are over. Use credit cards. This is a cash flow issue. Are you one of those people? Come on. We are here at the company. I don't do this personally, and there's a flaw, right? I probably should. But at our company, we buy everything on a card, and it's an obscene amount of points that they give you. So it's like, okay, just have every bill go to that, all of our software charges and everything. Just put it on that. Basically, every quarter, we end up with hundreds of thousands of points, and you can reimburse yourself for travel and all that stuff, yada, yada, yada. It's a good time to look and see, is that the best card for us? You know what I mean? Like, we've had it for years. There's nothing that's going to hurt us by changing it and moving it to another card that may offer other points and stuff. Just a quick glance. There's websites for that and stuff these days. All right, looking at your asset and debts here, have you, the main thing I'm trying to point out in this first one, your retirement goals, risk tolerance, the main thing is the goals. Did you want to retire early now? There's this big push between, living life and balancing work, and then realizing that work is also life. And I don't know where it started from, but I hear a lot of it. So that means that somewhere on the internet, you're getting targeted for that. And maybe you want to retire early. Of course, that's something that means your number should change. If you're one of our clients, we have our new retirement planner right in your portal. We custom built everything. So if you want anything in there, you need to adjust or you need help with that, of course, let us know. Emergency savings, right? We want to have at least 6 months there if possible. 1 year if you're in a cyclical employment type situation. That would be things like real estate, construction, anything cyclical where maybe you want to have a little extra savings. It's not as easy to find that job like in other service-based industries. Are there high levels of cash in any of your accounts? How efficient are you being with your cash? Now, we're focused here on the insurance level, but that's not such a big deal anymore. I'm focused on the efficiency of your cash. In fact, I may be building something else that kind of focuses on those things so that I can tell if clients are being efficient with their cash. But we no longer live in a world where you can have cash just sitting there doing nothing. That doesn't mean you take risk with it. Please don't clip this part out and pretend I said that. That means that your cash just can't sit idle. We have inflation, we have low savings interest rates and payments for using CDs, high interest savings. It's getting better, but we need to be more efficient with our cash. That's what I'm talking about there. Just ask yourself the question, do we have a lot of cash that we're probably not being efficient with and should start moving towards one of our goals, whether they're short-term or long-term? This has happened a lot. This was more last year than this year, but did you fall for one of the high-flying stocks and you bought a lot of it and you got in a little trouble? You know what I mean? Look at that. Is there an opportunity to take a tax loss there and start paring back your risk a little bit? It happens to someone every year, but last year was a more prominent than this year. Property. Now you can imagine that if you had a business, had a property, multifamily property, had a commercial line of business, had an airplane, something that you sold where you generated some kind of income or loss from it, naturally that's something that has a tax consequence. We want to look at that. If you own a business, did you give up some ownership? Did you acquire a new business? Did you buy out shares? Do you have any RSUs? Do you have different things inside of your business that were big purchases? Did you try to go for your the IRS code where you can buy a big vehicle? Did you fall for that? And now it's time to make sure all that's set up. So time to focus on that. And that this is more of a, yes, there's been big changes. Oh, I do need to let my accountant know. Maybe there's no action on your part, something to look at. Any significant expenses in the near future? This means that, oh boy, maybe we should come back up and revisit this here. Do we have surgeries coming up? For example, I gave you the scenario where my wife had a major foot surgery. We knew of it coming up. We saved for it. We put money in an HSA. We took advantage of that discount, and now we don't need the money, so we're going to actually reimburse ourselves in the future for a trip to Italy or whatever we want because, well, the law says we can do that. So if you have a heads up on that, maybe time to start planning. New debts? Come on. According to the New York Fed, a lot of you have taken on new debts. It may not be a bad thing, but of course that adjusts your budget. Any interest rates on your debts changed? Are they adjustable? Did you have a HELOC and you maxed it out and all of a sudden the HELOC went up because rates spiked so much? Do we need to address that? Should we consider rolling that into a actual fixed equity loan? What would be the benefits there? Credit score, do you need to review it? My clients know that you review it once a quarter, except for the last quarter. We give you that quarter off. That allows you to check your credit report at the 3 major credit bureaus once a year for free with all the details that you need. And then over the holidays, you can take a break and go enjoy yourself. Anything you're forgetting, and this is more from a planning standpoint. When you're working with us and you're using either the planner that is in your portal or you're using Nest Egg, I can only rely on the data that you've given me. So is there anything that you may be forgetting inside of that? A lot of people have inherited portions of a property. They've been paid out from trusts, or they have an expected payment coming from a trust. Maybe a parent passed away and there's a portion of a beneficiary type annuity that's coming your way. Is it taxable? Is it not? All those great things. Now's a chance to just take a quick look and say, is there anything I'm forgetting to include in my plan? Now we'll just move on to insurance. This is not a big deal. Do you want to review your healthcare options? Maybe not the best of timing for this part of this video, but should you be reviewing those healthcare options? Should you be adding an HSA? Are you eligible to add an HSA there? Should you consider any life insurance, long-term care insurance? Term life insurance is stupidly cheap. And if you have anything in your life you want to protect upon your death, go shop around for it. We do not sell life insurance, so that is not a biased answer. And to that, I will add disability insurance is incredibly cheap given what it actually covers. What if you get hurt? You know what I mean? You got your dough straight, everything's working out, and you get hurt. I see it. That's the only reason I bring these things up and actually kind of show some kind of emotion. I see it happen, and it hurts to watch. Changes in your compensation. Did you have a baby? Or new liabilities. Now, this is in the insurance section because maybe you want to have a life insurance policy for your kid to go to college if you happen to die and you just had a baby or something. You're talking pennies here to make that happen. Or you want to protect the mortgage on your property should you pass away and you don't want your kid to be homeless with your spouse and all of that. Just think worst case scenario, attach a dollar amount to it, go shop around for life insurance and find out that it's cheaper than what you put in your head. Have there been any changes to real estate holdings that may make you want to increase your protection there? This 2022, we noticed that our real estate values went up rather sharply, and although they're pulling back, I bet you they're still higher than where they started. Does that make you want to consider how much you should be covered for in the event of a catastrophe? Keep in mind, this is an old Clark Howard tip here, that if you live in a community that Lennar built or Toll Brothers or some major home builder, you are covering yourself on the replacement value of the property as if you are going to also build 1,000 homes in a community. Remember, the replacement value for you to replace a singular item or a single story of your house is going to be much more expensive than what Lennar had to pay to build 1,000 homes in a neighborhood. Economies of scale, right? They got a better deal, so be careful of that one there. Any changes to health situation maybe make you want to look at your different types of benefits. Does it make more sense to pay more to get more coverage because your health has gone downhill? That is essentially what we're covering there. Looking at your tax planning issues, this is more, should I alert my CPA? Should I work with my advisor to ask if I should talk with my CPA, or maybe hire a CPA this year? Maybe you've been a TurboTax guru your life and now it's time to move on. Did you do your taxes last year and you found some surprises? Did you get one of those letters in the mail that says, well, you know, you gave us this number and we, the IRS, think it should have been this number? I got one. I'll be honest with you. It was, thankfully, a minor mistake. But yeah, I put the wrong number down and the IRS figured it out and said, well, we think you owe us this plus a couple $100 in penalties. I said, well, I tried anyways. I have asked for a one-time abatement in the past. I sent a letter back in and said, I'm asking for a one-time abatement. By the way, when you do that, put an envelope in there, pre-stamped with your address on it, and just write on there that you're asking for them to acknowledge it. Just simply mail the envelope back to you so that you know that they got it if you're not going to do the certified mail thing. Even if you're going to do certified mail, it's nice to know that somebody got it. So were there any surprises? Do we need to address that? Make sure that doesn't happen again. I know I did. Did you receive a large tax refund last year? Don't fall for that. Getting a tax refund is nowadays really a waste of your money. Your new W-4 makes it super, super simple to calculate how much you need to withhold in taxes. There is no reason these days that somebody should get an extra large refund back. So you may want to change your withholdings there. Spend 10 minutes on the W-4 if you're obviously an employee. Windfalls. Mainly the one I'm talking about here is RSUs and stock options. Did any of that apply to you this year? If so, we need to get planning for that. That's not the kind of thing you want to wait till the last minute to figure out because you have to pay tax on those. Do you expect your income to change in the near future? Tell your CPA about that. There may be things you can start in 2023 to make sure that your tax bill does not look like what it is going to look like this year. Remember, taxes, your bottom line tax due is going to go up in 2022. Isn't that amazing? Right? The tax laws didn't really change, but you are going to pay more tax in 2022. Make sure we're getting a head start on that. Unrealized gains or losses, and mainly the thing I'm focused on here is your loss carry forwards. Don't forget those. If you're using TurboTax, they carry it forward for you. But if you're doing it the old-fashioned way, remember, if you have losses from the previous year in excess of $3,000 net, you're allowed to carry that forward to the next year. And if you're going to make any non-charitable gifts, your limit this year is $16,000. We'll go ahead and move forward with that. That is cash, unless you're doing different types of charitable gifts that may fall under your IRA, maybe trying to use part of your RMD, maybe you're giving stock away. Just make sure we're following the rules on that one there. And let's move on. Estate planning here. This is long-term stuff. I say estate planning, please keep in mind this is all-inclusive. When I say estate planning, I'm not saying like, start a trust or whatever. I'm just saying big picture stuff, outside of the norm you would look at here. Goals. We kind of touched on this a minute ago, but if your goals changed, if the answer is yes, what are you going to do about it? You have to do something because your financial goals have changed. Maybe you're going to have, try to have another baby. Maybe you're going to try to have 2 babies and move into a bigger house. These are all things that you can address. They don't have to be last second things that we freak out about. This one doesn't usually apply to too many people. I have maybe a handful of clients that I can say that this applies to. Just read it, take a look at that. Beneficiaries. This is a big one. Big one. Do your beneficiaries need to be reviewed? Remember, in an IRA, Roth IRA, SEP IRA, 401k, 457, TSP, did I say yours here yet? In those accounts, you are specifically defining your beneficiaries. In a brokerage account, it's a little bit different. You don't have beneficiaries in a brokerage account. Did you know that? Most people don't. You are actually saying, when I die, transfer this account on death. No questions asked. This is the person. This is where you find them. Move it to them. There is no need to follow any other rules. Please make sure you have someone that you actually want the money to go to. Last year was a record year for clients that got divorced. I'm sorry. I don't mean to make that public, but we follow data like that. And so could you have possibly forgotten to change your beneficiary to your new spouse? Assuming that you have one, right? Could you have possibly forgotten to change your beneficiary from your ex-wife, husband, whatever, to your children? Great time to review that. It takes longer to log into your account than it does to change the beneficiaries, and you can change them as much as you like. And that leads us to the divorce question there. Any big changes to the family? Sad to say, we had a client that lost one of their children, and that's a big change. And that's a hard one to just start talking about right away. So naturally some time would pass, and then we have to just start answering the tough questions there. If your spouse passed away, obviously I don't expect to know the day that happens, but as things like that happen in your life, there are both opportunities and unfortunately there are some things that are going to hit you a little bit there. So we at least need to start talking about it whenever you're ready and whenever we can. And hopefully if that happened this year, then I've already heard from you, I hope. But if it happens next year, we've got all year to plan and I'll take as much time as you need. But that basically sums it up there. Things that you can do to just quickly answer yes or no. And if you answer no to every single thing, something's wrong. Go back and do it again. I'm just being tough on you, right? Because you're going to answer yes to something. There's no chance that your life just magically went by this year and nothing happened. I consider this year for me a year where things just kind of worked out. They didn't really change. They didn't really get worse, better, nothing. But I can still answer yes to a lot of those questions, which means maybe you yourself can now take that information, go get help, dig a little deeper, research online. The IRS website's gotten pretty good over the years, actually. So things like that may be, warranted. If you don't, then honestly, you're just lazy. And you can hate me for that. But if you won't take a non-biased, non-solicited type educational video and say, well, you know what? Shoot, I did that last year, but I was supposed to think about that this year. And you don't do it, there's nothing I can do. You're just lazy. And so hopefully being financially strong and consistent is in your vocabulary. If you had a lazy year, I can certainly understand that, but now's the time to get that fixed because what have I been saying? Money is getting tighter. I see it every day. We have clients all over the country. And when something starts to shift, it's so freaking crazy how I can just pinpoint that and go, something's different. The most recent one was the COVID scams. As soon as people started falling, I could see it starting to happen. People falling for some of these COVID scams. I would get a phone call and I almost knew the words that people were going to say. As soon as money gets tighter, I see it. I see people moving money differently and all of that. I'm telling you, take it from someone that's using data to look at that and go, whoa, money's getting tighter. It's not getting better out there. I'm not saying the world's ending. I'm not saying the market's crashing. I'm not saying the economy's going, haywire. I'm just saying money was loose. Money is tight. Don't wait until you find out that, oh my gosh, money's a lot tighter than I thought. I can't save as fast. I can't put away as much money as I could. Please focus on that. There's your heads up. In the meantime, what is not tight is this glass that's still full. So I'm going to enjoy the rest of this drink and see what else we can talk about. If there's anything you'd like me to cover on our Jazz After Dark here, we're just hanging out, keeping it real and enjoying a drink together. I appreciate it. Any comments or video topics that you would like that, of course, I can help with, I'm happy to do that. Enjoy the rest of your evening. That's all I got.